We're passionate about helping real estate investors and business owners really uncover, hidden opportunities for their properties and really improve their cash flow. And
Hello, and welcome to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Hello, we'd like to welcome you all to the Mornings with Joel CRE podcast. We're very excited to have you with us today. And we have a special guest that's actually going to be talking to us about something we're all concerned about, and that's a CPA to discuss taxes. So don't hang up. But there's good information that you're going to want to know about related to cost segregation and a bunch of other things if you're already familiar with cost segregation. So we have Amir from KBKG. And what's up, Amir? How you doing, man?
good, good. Hey, thanks for having me on the show. Excited to be here. And that's right. Yeah, I'm Amar Patel here. I'm one of the principals here at KBKG. So excited to kind of, talk to the group. We're passionate about helping real estate investors and business owners really uncover, hidden opportunities for their properties and really improve their cash flow. And like you said, reduce taxes, right? It's that time of year. So hoping to break down what cost segregation really is, how it works, and why I think it's one of the most powerful tax planning tools when you talk about real estate. So
Yeah. Well, that's very good, and that's important. I definitely am going to dive into that, and I want to cover it. As you mentioned, some of our viewers might be familiar with that already, so we're going to say a little bit of that toward the end. But I did want to talk about you guys because you're a partner in this group, and who exactly is KBKG? Because you're not a little startup.
no, we've been around since 1999. So essentially, how I tell folks, KBKG, we're not tax preparers. We're essentially a nationwide firm that provides turnkey tax solutions to CPAs and business owners. Right? Our team here at KBKG is a mix of CPAs like myself, attorneys, and engineers, and really that mix of talent, I think, in my opinion, is why we can offer these specialty tax projects to our clients. And like I said, I think for real estate investors, cost segregation, which is the group that I head up here in the Southeast, is really designed to uncover opportunities to really improve cash flow and reduce taxes, like I mentioned. And it's a nationwide firm. We have 8 offices spread throughout the country. I head up our Southeast cost segregation practice here in your backyard in Atlanta. We have offices in Dallas, Houston, New York, Chicago, and headquartered in Pasadena, California. So
Okay.
we'd like to think we're all over the country providing strategic tax planning ideas for our clients.
Gotcha. Yeah, I was actually just out there in Pasadena and Glendale and Altadena and all those areas. Were you guys affected at all, or was everything okay?
Yeah, no, our headquarters was not affected. We did have to evacuate our offices, but thankfully none of our employees in Pasadena were directly affected by the fire. So
Okay.
that's thankful, but it was a serious issue for a lot of the folks that were there. And,
Yeah.
still cleanup is still happening. So I'm glad you brought that up because it is one of the things that, was scary at the time for our folks out there. So.
Yeah, I could imagine. So, well, thanks for sharing that. I didn't want to be oblivious to the fact that you guys just went through a very traumatic situation. It's only been, what, 9 months, maybe 10? Because it was back in January. So,
Yeah,
very serious situation.
exactly, with, flooding. We've gone through some flooding, fires, and it's been, quite a year for our folks out in California.
Tell us a little
Yeah.
bit about who you are and
So
how'd you get to be partner? I mean, come on, you must
yeah,
know
no,
something.
great question. So I do head up our Southeast cost segregation practice. I'm a graduate of the University of Tennessee. Graduated with a finance and accounting degree and got my CPA license shortly after graduating. And I started my career in public accounting at PricewaterhouseCoopers, where I spent 15 years in their specialty tax group, really focusing in on fixed asset capitalization related projects. And that really dovetailed into working with clients that were more capital intensive, real estate investors, and had a broad range of clients, right, from public clients to mid-sized private clients and even individual investors. And what I found out after 15 years is, hey, I like specialty tax. So
Hmm.
for me, it was a logical next step to join a company that focused primarily on specialty tax. And that's how I landed here at KBKG. And there was a need for a partner to open up and head up our Atlanta office. So it was a great natural fit for me geographically, and yeah, it's been a great transition to the specialty tax world. So
Okay. Well, good stuff, man. I'm excited to hear that, and I'm glad you like what you do because
oh yeah,
a lot of people don't like playing with those numbers.
what I tell folks is anyone that's willing to listen about taxes, I try not to keep people, put people to sleep, and that's why these conversations I like to keep them high level and really put these difficult tax terms into layman's terms so people can understand.
Three other areas that I just want to touch on that you guys offer that you might be able to provide a little bit of insight on. I understand you're the cost segregation guru, but there's mention of you guys' efforts in the research and development tax credit. If related to real estate, because obviously there's a lot of pre-development costs and other things associated with that, which equates to a lot of money out the door. How does that come into play? And do you have any background on how that's actually used in a situation related to real estate?
Yes, well, I've seen it, and we do have, right. You're right. One of our three big divisions is R&D tax credits, green energy building incentives, and then cost segregation, as I mentioned. And
Right.
when it comes to R&D tax credits, right, in the purview of real estate investments, what we typically look for are software development costs or software that you've created, and really trying to identify the amount of research and development that goes into some of these software solutions that real estate investors may be implementing in their processes when identifying, properties to potentially acquire. And essentially how it works is it's a wage-based credit, right? So those individuals performing the research and development, we get a certain percentage of their wages as a direct credit for tax purposes. And then also any supplies that are used in the research and development efforts, contractors that may be hired domestically to help develop some of these solutions would qualify for these credits. I will say for real estate developers, it's rare that an R&D credit would apply, but that's not to say it doesn't, right? And what we like try to look for is those software solutions. And really, these R&D credits are it's a lot broader than what you think about when you think R&D, right? It's not just, eh, you know, labs and things of that nature, right? It's manufacturers out looking to improve their products and processes. A lot of those incremental costs that they're incurring that could qualify for the research and development tax credit. So I will say, from the real estate perspective, kind of looking at software could potentially be an opportunity to claim the R&D tax credit.
Okay, all right. Well, that's good to know. I was thinking, would there be an application? Because we do have some clients that are in the life science space, and that's pretty much all research and development.
Yeah,
So, would there be
absolutely.
any application there possibly?
Yeah, uh,
Okay.
yeah, there would be, right? And so that's kind of what I was alluding to, right? Anytime you or your clients or your investors are incurring costs to improve
Mhm.
products processes, those are the types of things our R&D tax group would want to understand to make sure that they fit into, I'll say, the broad box of what qualifies for research and development. So certainly,
Okay.
that's something you can reach out to me and get you in touch with some of our partners that head up the research and development group to see if potentially, your clients or customers or listeners do qualify for the R&D tax credit.
Gotcha. Gotcha. All right. Very good. Let me briefly tap on also about the repair and capitalization review. I know that's a review that you do. A lot of our clients or listeners, I should say, also are involved in the value add acquisition of multifamily housing and other properties like that. How could that come into play as it relates to capitalization?
Yeah, so that's a great question. So the tangible property regulations, which came out back in 2014, really are designed to help taxpayers, right? In your instance, multifamily investors that are renovating or incurring these what I'll call routine maintenance expenditure, right? So big ticket items like roof replacements, let's say, or HVAC replacements, generally for financial accounting purposes, they're going to capitalize those costs. But for tax purposes, there are opportunities to potentially deduct all of those costs if they meet the qualifying criteria, which is pretty broad, right? So when we talk about, the repair or replacement that we see in multifamily, the renovations that are going on, a lot of those types of, drywall repair, painting, they're all going to be costs that we'd wanna look at to see if we can't outright deduct those costs for tax purposes versus capitalizing and depreciating those costs. So what these studies are designed to do is really look at the taxpayers' depreciation reports to see, hey, are there costs that we've incurred in the current year or even prior year that could be deducted for tax purposes, really in an effort to increase your deductions in the current year, right? And, if we're looking at a roof replacement from 5 years ago, the great thing about these types of studies is you don't have to go back and amend any prior year returns. You can kind of analyze those costs to see if, okay, they should have been deducted, 5 years ago, and I can push those missed deductions into the current tax year, even though I missed it in the prior tax year.
Okay.
So it is a valuable tax planning tool when you're going back and kind of reviewing your comprehensive fixed asset ledgers to see if there are any opportunities to outright deduct as a repair some of those renovation and improvement costs.
Okay. How far back is the look back on that? That's a good point that you brought up.
Yeah, you can go as long as you have a remaining basis in those assets, you can look back as far as you want. We typically tell folks 20 years, right?
Really?
20
Uh,
years is funny. If you do keep
yeah, if we have it that long. Yeah.
if you have folks that are there, maintenance folks that are there that can describe what was done, we can certainly analyze those costs and have those conversations to determine if there are any missed deductions. So, there really is no limit. We generally kind of say 20 years and make sure we have records that we can leverage to effectively take those deductions in the current year.
Gotcha. Gotcha. Okay. Well, that sounds good. How does that relate to the 445L credits for energy efficient, opportunities? Because obviously that comes into play with multifamily as well. So,
Yeah. So
how would that work?
Yeah, so 45L, that's, really looking at the energy efficiency of, the units, right? And you get a per unit credit, right? And unfortunately, that 45L is actually going away. So that really was an opportunity, for the last ten years where you could look at, your residential portfolio to see if there are potentially qualifying credits that we've missed. So
Mhm.
going forward, that's not really an opportunity for most taxpayers and developers, but certainly is something we can look at, going back to see if there are any opportunities that we've missed in prior years. But that really is one of the green building incentives that, unfortunately with a new administration is one of the things that got taken away in the most recent tax law updates.
Oh, okay. I was going to ask you about that. Is as it because sometimes what happens is these programs get rolled up on other programs, and so they might be hidden in other areas where you can still apply them, but they're not just kind of out there on their own. But you're saying that's probably not the case here. This is just kind of going away.
Yeah, unfortunately, this one is gone away for the time being, and who knows? But the next administration potentially could be brought back, but currently it's not something that's applicable for 2025 and going forward.
Okay. All right. Gotcha. Gotcha. I did want to ask, and because the 263 to 45L and all of these, they seem to potentially work in harmony with PACE and PACE credits. Are you familiar with PACE at all? And do you know if there's any conflicts between the PACE and how that operates in these particular offerings?
Yeah, yeah. So one of the things I focus on renewable energy credits, and when I've dealt with PACE, it's really into the purview of these renewable energy credits, and to the extent the PACE funding that we've received is considered taxable income, and you're going to utilize those funds to acquire, or construct, or renovate assets. Then certainly, these depreciation techniques are opportunities to look at, right, to see if we can't accelerate those deductions. So I haven't dealt with PACE outside of the renewable energy, but the rules are the same, for using those fundings for other improvement projects outside of renewable energy projects.
Gotcha, gotcha. All right, so there's no conflicts per se.
As long as it's considered
Yeah.
taxable income, as far as I know, there would be no conflicts because the
Okay. All right. Gotcha. Just wanted to make sure. All right. And then one thing I know also before we jump into cross segregation is you guys offer a fixed asset view, which I think could really be of value to analyze what you got and see if there's some ways you can enhance the tax
yeah,
efficiency.
Yeah, and that's kind of what I was referring to earlier when we're talking about kind of renovation and repair costs, right? Is really looking at clients' fixed asset registers, and we can do this for free, right? Is look at it to see if there's any opportunities that, hey, we've missed costs that we could deduct as a repair expense, or there's
Hmm.
assets that have been misclassified as building costs that should have been, personal property, right? Things like carpet or appliances, and again, it's the same concept where we don't have to go back and amend any returns. We can file, the Form 3115 that I was referring to and really pick up all those missed deductions in the current year. So that's really when we talk about comprehensive fixed asset reviews, that's really what we're doing is looking at all the capitalized assets that you have reported on your fixed asset ledgers to determine if any of those tax planning strategies that we're going to talk about, right? Repairs and maintenance, misclassified assets, or even cost segregation can be applied to those
Hmm.
older assets. So that is a technique that, if your CPA or tax preparer is looking for additional deductions or you have a big slug of income in a given year, reviewing your fixed asset ledgers to see if there are any opportunities is a wise tax planning idea. And that's something we do for our clients, but we can kind of scrub the fixed asset ledger pretty quickly and identify any missed opportunities there.
Okay. Okay. All right. Well, that sounds good. That sounds good. So that sets us up actually real well for a cost segregation discussion. What I want to do right quick is just let's pause for a minute for our sponsor, and
Sure.
then we'll be right back.
Sounds great.
All right, fantastic. So we appreciate that. And so let's, I wanted to mention this also to our listeners. If you have questions for Amir that you want to get addressed, specific questions, please get those in the chat. And Jomar will get those over to us and we'll make sure that we address those questions and, get you some good answers on that. Let's see. I think there might be a new one here already. Okay. Yeah, that one's already been addressed. So, but yeah, get those questions in now and we'll be happy to address them. So, Amir, as we go forward with this, what exactly is cost segregation for people who have never heard about this before? Let's start
Yeah.
there and we'll build up.
Yeah, sure. Yeah, and I'll keep it pretty high level. What I like to tell folks, cost segregation is strategic tax planning or incentive tool that's really based on the principles of engineering that allows, real estate owners, investors, or even tenants, right, to utilize these studies to increase cash flow and reduce their tax liability in the current year, right? And it's by accelerating depreciation deductions on certain components of their property. Right, and what I tell folks is the primary goal of a cost segregation study is to really identify, building components or building improvements that generally will be depreciated over 39 year for tax purposes
Mhm.
if we're talking about commercial properties, or 27 and a half years if we're talking about residential properties.
Mhm.
And the idea is to identify those components and identify which ones can be depreciated over 5, 7, or 15 years for tax purposes. And by doing so, you're really opening up yourself the opportunity to potentially write off these components in the current tax year, based on some of those recent law changes I was talking about. And if you think about it, Joel, like when you're dealing with large building construction projects or large acquisition projects, any components or any portion that we can move to a shorter tax life is going to result in a significant induction for our clients. And
Mhm.
what I tell folks is, as a general rule of thumb, based on my experience, we typically expect, anywhere from 15% to 35% of those building costs to be eligible for these shorter tax life treatments. And a lot of the questions I get are, what types of components are you talking about, right? So it's things like flooring, cabinetry, decorative, lighting, millwork, landscaping, parking lots, all of these components that when our clients are acquiring property, typically those aren't broken it out. And that's where we come in and we try to identify which, portion of the acquisition price can be attributable to some of these personal property items. And those are just a few components that we try to break out in our cost segregation studies. I like to give it just a simple example, right? Let's say one of your investors is buying an office building for $3.9 million. Let's assume no land value, right? Your CPA would probably depreciate this building equally over 39 years. And essentially, what you get is about $100,000 of deductions per year for 39 years. Now, if you do perform a cost segregation study, let's assume 25% of that cost is identified as a short life asset, well, that means 25% of that $3.9 million of cost are eligible to be deducted in year one. So what that means is $975,000 of deductions right away. And that's, $875,000 of additional deductions if a cost segregation study was performed. And really, if you tax affect that, using a 20% tax rate, that's $175,000 of cash savings in the current year. And that's really key for any real estate investor, right? Freeing up that cash in the near term. And one of the things I do like to note is that when you do a cost segregation study, we're not creating any new deductions, right? We're really just front loading as much of the deductions into the first 5 years as we can, really in an effort to free up cash in that current year. So at the end of the day, what I tell folks is, you're not really creating new deductions. We're just trying to push as much as we can into those first 5 years.
We were talking about being able to go back into the past and look at these assets even up to 20 years and look at where we might be able to accelerate some of the deductions in order to benefit ourselves from a tax basis. What else were you saying about that? And then I had a follow-up question for you related to that.
Yeah, the one thing, and that's a great question, right? What I generally tell folks, cost segregation and some of the other tax planning ideas we had talked about earlier are great tax planning tools for those investing in real estate or incurring some of these renovation costs we talked about, because these studies can be performed in the year the assets are in service. But it is important to note that, these types of cost segregation reviews or reclassifying assets, it can be performed in a later year, allowing the taxpayer to take advantage of those extra deductions when they actually need them, right? So, if in 2025 a real estate investor is not taxable, well, then look, we can always wait until 2026 to do the project. And essentially, where I was getting at is, if we're performing it in a subsequent year, there's no need to go back and file amended returns. Instead, what the IRS allows us to do is file what's called an accounting method change, or Form 3115, to catch up those missed deductions on the current tax return. And that's really why I think these types of strategic tax planning tools are great for those investing in real estate, because these 3115s, they don't require IRS consent, right? Your CPA or firms like ours, we compare those forms, calculate those missed deductions, and really just essentially attach those on your current tax year filing. And that's going to have real value for you if you are in a taxable income position. So that's
Okay.
that's really what I tell folks is you can apply it retroactively. And the key is you don't have to go back and amend returns, which we all know that that can be a headache for for tax preparers. So
Yeah, yeah, absolutely. Especially if you're looking that far back, that could really, really be a nightmare getting all that together. And I would think also it might ultimately create an audit, which nobody wants. So, you
yes,
got to be weary of that.
and that's definitely something. One of the things when I talk to my clients about cost segregation, especially those in real estate that don't or haven't heard about it, like what are some of the you know common misconceptions, right? One of the biggest ones is performing a cost segregation study is going to trigger or a red flag for an IRS audit or exam. And what I tell folks is we can't guarantee a tax return is not going to get put under exam, but by no means do these types of studies trigger an examination, or filing that accounting method change does not trigger an examination. But the good thing is, most cost seg providers, particularly KBKG, if any of our projects do go under audit, we provide free audit support, right? And with all of our engagements, and that's something we pride ourselves on. And one of the things I always tell folks is, there is an organization out there, the American Society of Cost Segregation Professionals, and really this organization is the organization that provides continuing education, code of ethics, and really technical standards for the cost segregation industry. And the organization works with the IRS to standardize deliverables. And the good thing about KBKG and many cost segregation providers out there is, we're all certified members, and all of our deliverables come stamped from a certified member once they
Mhm.
review the project. And that's key because the deliverables that we produce are all IRS audit ready, and they're actually prepared based on the data points that are derived directly from the IRS's own audit technique guide, which essentially is something they provide to their own exam agents when auditing
Mhm.
cost segregation projects. So, everything an exam agent would expect to see in a thorough cost segregation report is required for us as members of this organization. So, all that to say is it really does, if, for some reason your project does get looked at by the IRS, the deliverable in itself should have everything an exam agent would need. And if it doesn't, we're there to help supplement any questions they have as well. So that's one thing that I tell folks is, if you're hesitant about doing a cost segregation study because of an audit, we do provide free audit support. And a lot of these cost segregation firms, their deliverables are designed to be audit ready. And then the other thing, like when I talk to folks is, cost segregation studies those are kind of advanced tax planning ideas for large corporations or kind of those high dollar value properties. And in reality, many mid-sized investors that we work with, you know, definitely benefit from these types of analysis. And, the miss
What do you define as mid-size? That's a good point. So what do you define as mid-size?
yeah, so anybody that owns income producing property that has a basis of more than $150,000, it
Really?
would make sense to at least look at a cost segregation study to see if it makes sense. And one of the things I tell folks is, there's a lot of providers out there, but what you want to make sure is that they're performing these, particularly with acquisition studies when you acquire a building, that they're done using IRS approved engineering
Mhm.
estimates, right? And that's really where, any cost segregation professional that's part of the ASCSP that I just talked about, we
Mhm.
all use IRS approved cost estimation. And that's key when you have real estate investors that are buying properties. Oftentimes what we see is, original construction blueprints or invoicing is not available, right? When you buy a property that's older,
Yeah.
and that's where we come in and we can walk the property, do a physical inspection, and essentially reverse engineer your property based
Mhm.
on these IRS approved engineering cost estimates. And that's why it's critical to use a cost segregation company that has the engineers on staff that can perform those types of studies.
Right. So let me ask this: Where at what point is it cost prohibitive though? Because
Yeah, no,
they were saying, yeah, that 150. I think you said 150,000, if I heard you correctly.
that's right. So
Yeah.
what I think sets our firm in particular apart, that's our general rule, right? When you have particularly residential properties are usually the ones that have those smaller bases.
Hmm.
We saw a need in the industry, quite honestly, for, folks that own these smaller rental properties to take advantage of cost segregation studies. And what we've essentially created is an online self-service tool that's specifically tailored for residential properties with a basis between $150,000 up to $1.2 million. And what I tell folks is think about TurboTax, right? And this is
Hmm.
essentially TurboTax for cost segregation studies, where the end user, the real estate investor, their CPAs can essentially go into our software, enter in relevant property details, and within minutes you'll get a cost segregation report that outlines your accelerated depreciation benefits, your cash tax savings, and really, it's a cost-effective tool that many of our clients utilize to provide cost segregation benefits for those residential properties at a fraction of the price, right? When you talk about cost prohibitive, it's a fraction of the price you'd pay for a full-blown engineering study. Our reports generally go for $499 to $900 for that online tool. Whereas most cost segregation providers, when you're talking about larger residential or commercial properties, the fees could be north of, $3,000 up to $20,000, right? And so that's when I say when you have $150,000 of basis, those are the smaller basis properties that are designed for these cost-effective online solutions that we've created. But if that's not something folks are interested in, you're looking at commercial properties, a good rule of thumb is, $500,000 or more. That's when we try to see, we always do a free kind of feasibility study to see what the ROI from the cash tax savings would be. And if it's anything less than 10 to 1, we typically, educate our clients on the fact that, look, we'd like to see ROIs more than 10 to 1. And so that's where we kind of look at how old is the property, what's the basis, And just a couple of those data points will help us understand if cost segregation does make sense for, anything less than $1 million.
Gotcha, gotcha. Well, that's good to know because yeah, even though I'll give you an example. One of my buddies is they own a very large Mid Atlantic fund right now, and obviously I'm not going to mention who it is, but he mentioned that they own a lot of real estate. He was like, "There's stuff I won't put on the website, because it's small, dinky, little single family stuff.
Yeah.
They own a ton of it because it serves as a basis for, if they are in a credit crunch or cash crunch for whatever reason, they could dump one of those properties and still keep rolling. And so that's interesting to know because a lot of times, as people are building up, they are building up smaller portfolios and whatnot. So I think that's good to know, and that there is a smaller basis that you could get in that wouldn't be cost prohibitive.
Yeah, and
Um,
and that's where, the feasibility analysis I'm talking about, we really wanna understand our clients', tax posture, right? And so one of the things we always like to do is really make sure when we're selling cost segregation studies, it's actually going to benefit our investors, right? There are, a lot of folks may be into flipping houses, right? And we're upfront with them. There is a notion of depreciation recapture when you sell an asset for a gain. You do have to recapture the accelerated depreciation on the back end. So when there's instances that we're going to sell a property within 1 to 3 years, well, I often, I'm upfront with the clients. It's not going to make sense from a cash tax savings perspective to do a cost segregation study if you are intending to sell a property within 3 years.
right.
Or another common situation is, they're a passive investor, right? And there are, not to get too tax technical here, but there are limitations on how much deductions we can utilize when you're a passive investor, right? You can really only offset passive income with those deductions. So, in certain situations, we're upfront with our clients where if you have one single family home and you're looking to do a cost seg and it's a passive investment for you, we're more than happy to do a cost segregation study, but understand that we're going to generate a lot of deductions. And if you're passive, your rental income on that property isn't enough to sustain it. You can't put yourself in loss more than, $3,000. So you do get a carry for those deductions. But, again, just being upfront with folks and really understanding, everyone's tax situation's different. Every investor is different, whether they're passive or active. And we really try to dig in and understand, those situations. And, a lot of what we do is educate, right? If folks are in a passive position, well, how can I become active? And there's different strategies out there, right? The real estate professional status, right? If you're a W-2 owner, you have a couple of rental properties, maybe it makes sense to get your spouse to meet some of those hour requirements to then free up some of those deductions that we're generating to then offset, some of your active income. So that's kind of what I do as a CPA is really help educate folks and find strategies that help real estate investors take advantage of some of these tax planning ideas. And
Okay.
we really want to dig in and really understand the
Right.
tax positions of these investors.
So let me ask you this also. I know that part of this is the acceleration of tax benefits. How does that impact you on a sale? Is there any clawback or other issues that a person might need to be aware of?
Yeah, great question. So yeah, what I was alluding to, yes, right. So to the extent you're accelerating depreciation, calling items personal property, when you turn around and sell the asset for a gain, that gain has to be split up between 1245 recapture, which is all the items we would identify in a cost segregation study. So what
Mhm.
happens is, let's just do a simple example. It's $1 million property. If we dig on a cost segregation study and 25% of that or $250,000 is personal property, when you turn around and sell the property for, let's say, $2 million and you're sitting on a, $1.5 million gain, well, $250,000 of that gain, you're gonna have to pay ordinary income tax rates because we've accelerated that much of depreciation. And what that means is you're gonna get taxed the highest effective rate. And then
Right.
the rest of the gain is taxed at the capital gains rates, 10, 15, 20%. But that's kind of the clawback you're talking about is that depreciation recapture. And that's where we kind of tell folks, if you're gonna hold the property more than 3 years, the cash tax savings, when you
Makes
net
sense.
present value it, it's still gonna have some value to do the cost segregation in the current year.
Right, right. Yeah, yeah. Well, very good point. That's one thing you gotta be aware of, because some people develop and then they turn right around and sell. So,
Yeah.
you don't want to be in that situation. Yeah, go ahead. I'm sorry.
And that's where, we had talked about when we first started speaking, those folks that have multifamily properties that have, costs that they've capitalized or improved their, properties, really need to take a look at that before you sell the property. Because if there's costs out there that you've capitalized that's going to increase your gain, well, you want to get
Mhm.
those off the books so you're not, you're not paying tax on those assets. So, if
Yeah.
you've replaced the roof that you've currently capitalized, when you turn around and sell the property, you have to factor in that capitalized remaining basis amount, into your gain calculation. So the original roof that you've replaced, you want to make sure you get that off your depreciation schedule so you're not increasing your capital gains tax that you're paying. So, and that's the other thing I tell folks is obviously I mentioned our cost segregations are designed to identify those 5, 7, and 15-year assets within your property. But we additionally take an extra step. Those items that are staying in the real property 39-year bucket, we're going to give you all those components as well. So
Mm.
your roofing costs, your HVAC systems, your plumbing systems, so that in 5 years from now, if you ever have to replace any of those components, well, your CPA, if they revert back to our deliverable, they're going to have a basis of, hey, this is the amount of roof that was originally on the asset, so I can get that off my books, even though I have to capitalize the new roof. So, just ancillary, you know, you know, aspect of our cost segregation studies that our clients do appreciate and their CPAs appreciate
Okay.
because it makes cleaning up their books when they do have these renovations much easier on the back end.
Gotcha. Gotcha. Well, we're coming up a little bit on time here, and unfortunately for the break that we had there, I apologize. Like I said, I don't control the power company,
That's
but yeah. But I did want to ask about this. I know that there's some laws that are changing as regards to cost segregation. You mentioned about the new administration and whatnot. So, what are some of these changes that we need to be aware of
yeah.
related to cost segregation?
Yeah, so there are a handful, but one of the biggest drivers and what I tell folks adds significant value for cost segregation is bonus depreciation. And essentially, what bonus depreciation it allows taxpayers to take additional first year deductions for any asset that's depreciated less than 20 years for tax purposes.
Okay.
Right. And so bonus depreciation has been in play for since 2001, right, in some form or fashion. But the current administration has increased that bonus depreciation percentage to 100% for all assets placed in service, January 19th, 2025, all the way through the end of 2029, which essentially means that, any item that or component that we've identified in a cost segregation study is going to be eligible for 100% write-off.
Okay.
The other big key change, and when we go back to the first Trump administration that was key for bonus depreciation was the fact that in 2018, bonus depreciation can now be applied to used or acquired assets, which, in my opinion, very impactful for those commercial and residential real estate investors that are going up and scooping up some of these properties. Historically, before 2018, bonus depreciation could only apply for newly constructed properties. And what we've seen in practice is significant uptick in the amount of cost segregation studies that we're doing post 2018 merely because of the fact that these used properties can now unlock bonus depreciation, whether it
Mhm.
be 50% or if it's 25 and after, it's going to be 100% bonus depreciation on these components that we identified.
Gotcha.
So that's some of the key, when we're talking purely cost segregation law changes that really have impacted our business in a positive way. We talked about R&D, right? There are some
Mhm.
significant favorable R&D repeal that happened, right? For capitalized research and development costs. Instead of amortizing those over 5 years, we are now allowed to deduct those, and that really opens up a lot of opportunity for taxpayers to take advantage of R&D tax credits as well. So those are kind of two key areas that really impacted our business here at KBK.
Right.
The one big beautiful act that came out of
Okay.
it.
All right. Gotcha. All right. Well, that sounds good. So, in conclusion, first of all, how do people reach you? And what would you say, makes you stand out as different? Cost segregation has become a big thing. We have a lot of people approaching us about it and everything else. And you've given us a few tidbits to what makes you different. You do some smaller size, but I didn't even know were practical. So I appreciate that. But what else stands out that makes KBKG different?
Yeah, so we have our software solutions that I talked about, right? With the residential cost segregation tool. We're actually rolling out a similar tool for commercial properties as well that have that lower cost basis later this year. So we'll certainly make your listeners aware of that once that's launched. But what I tell folks is, our mix of engineers and CPAs and attorneys, I think when you're talking about these tax planning ideas that are really revolve around engineering principles, makes us a lot different than, the tax preparers or CPAs that go out and do cost segregation study. We have engineers that understand blueprints and understand CAD drawings, understand the cost estimates we talked about earlier. And the fact that we have the most certified members of the American Society of Cost Segregation Professionals, right? And we have, board members on that society. And really, me personally, we've developed relationships with, from my public accounting days with exam agents, and we really understand what they're looking for when they're auditing these types of projects or even repair and maintenance projects. And that really has helped us customize our deliverables for our clients, really to maximize benefits as well as provide that audit support on the back end if any of the projects do get looked at. Some of the other things I tell folks, the free feasibility study. So, we like to dig in and really make sure some of the valuable tax planning ideas we're bringing to our clients make sense for them. And we do that on our own dime. And a lot of folks, may charge for that. But we do want to make sure when we're selling, real estate investors in particular, a product that it makes sense for them and they're going to actually achieve the benefits that we feel they expect. Right?
Right.
For me, when I close these types of, cost segregation, it's not really about just saving taxes. It's really utilizing that cash that you're saving, unlocking that capital and really helping you as real estate investors grow your portfolio by front loading those deductions, freeing up cash in the near term and, leveraging that cash for renovations, expansions, new properties. And we get a kick out of working with real estate. Once they get the idea of cost segregation, we always have repeat customers, and we can see their business growing, their portfolio is growing, and it's great to see, particularly here in the Southeast. Joel, you and I are here, and real estate development is crazy in Atlanta, and we're educating folks constantly about these tax planning ideas. And one of the things, I was at a real estate conference a couple of years ago, and a lot of our sales guys would tell you the same thing. Probably around 25% of folks that are investing in real estate have heard of cost segregation studies, and that's where we love doing these types of educational series is, really getting the word out there that there are, tax planning tools out there for real estate investors to utilize. And feel free to reach out to me. I know Joel probably has my email, my direct line. Shoot me a note if you have any questions, or if you're going on our website. We have free estimate tools for your property. If you have any questions, that's really what I'm here for, is really be a technical resource when it comes to cost segregation and overall tax planning. So feel free to reach out, and that's really what we like to do is educate folks on these tax planning ideas. So
Yeah. Well, good stuff, man. I
yeah,
really appreciate it. Got a lot of value out of that discussion. And, like you said, it's a lot of people entering this space, but it's clear that this is not a sideline for you. It's not a little appendage to the
yeah,
main business. It's
yeah. We're
what you
not
do.
exactly. We're not. Yeah, I love doing tax returns, but that's not the business we're in. We're here to help people save on taxes, essentially. So
Right.
that's what KBKG does. And
Mhm.
if you're looking for just a general discussion on taxes, we're more than happy to assist. So appreciate Joel. Give us an hour to educate your listeners and really get the word out on cost segregation and KBKG for that matter. So
Yeah.
appreciate the time. And like I said, we'll have to at some point connect. I know we're both in the same city, so looking forward to that.
Yeah, we'll make it happen. We'll make it happen. So yeah, it's been great. Certainly appreciate your time today, and let's keep the conversation going. And for any of you that do want to get in touch with Amir, we have that information. Just reach out to my office. We'll make sure we get it over to you, and you guys can take it from there, set up your appointments and meetings. So thank you very much for your time today. We thank you so much, Amir, and your group. We appreciate having you, and we want to thank you all for being with us today, despite our technical difficulties, here on the Morning with Joel CRE podcast. Look forward to seeing you next week, or actually, we'll be off for a couple of weeks, but we look forward to seeing you in the near future with a new show. So thank you so much. Look forward to talking with you soon. Have a great day. The Morning for Joel CRE podcast is sponsored by ImpactMask.com. That's M as in Mary, ImpactMask.com. The world's most breathable mask that has 99% efficacy, which is higher than an N95 mask, and it won't fog your glasses. Check out the science behind these incredible masks at ImpactMask.com.